Hey everyone, so today we are talking about how to defend short call options when the market goes up or the market rips through your strike prices and all your break evens. It is a possibility because the market is always very bullish. This is what I've noticed being in the market for the last 10, 15 years, that 70% of the time the market goes up, 10 to 15% of the time it stays sideways, and then the rest of the time it goes down. And that is exactly what I've seen on the implied volatility side of things. So the exact opposite, I mean, because they both are inversely related. So market goes up, volatility goes down. So 70% of the time market goes up, 70% of the time market implied volatility goes down. That's how I've seen it. I'm not saying, don't quote me on this, but this is what my experience has been with the market. So when you have short call options because you're trying to make some income on your stock positions, how do you defend it? What do you do? This is how you defend a short call options when the market goes up. Let's get into the theory first, and then I'll take you to the trading platform, and then I'll show you exactly how it works with the charts and everything. This is my version of it. So short call, this is how it works. This is a short call trade, right? So this is your strike price. You sold a strike here. I'm hoping you have sold a out of the money option, not in the money option. So meaning this is the stock price right now. This is where it's currently trading, right? You have sold it out of the money at this price. This becomes your break even point, meaning you collected this much max profit, and this is your max profit line, and that's the max that you will make on this trade. So this is the max profit line. From your strike, you get this much of the room based on how much you collect in premium. So if you sold it at $100, the stock's trading at, let's say, I don't know, 80. You sold it at 100, and you collected $5. Your break even then becomes 105, meaning the stock can go up to 105 before you start losing money. This trade, if I would do this trade, I would do it 44 days out or 45 days out at least. In this trade, you are collecting negative delta. You are collecting positive theta, which is I like negative delta too, depending on how the market is. You are short vol, meaning you're negative on vol. The vol has gone up and you've sold it, and then it's now coming down. And then you are negative small gamma because you're so far away from expiration. The row side does not even work. It doesn't matter, so I don't really put that here. This is the structure of the trade. Now, how do you actually defend this? What do you do? Let's go into the platform, and then I'll show you exactly how it works. So let's go into Apple. People are aware of Apple. Everything. It's a very popular stock. Usually, I would do this trade on a futures options because the capital efficiency that you get in futures options, and you collect the same amount of money, and I'll show you how. If you are doing it based on the index, the main S&P 500 index or the NASDAQ or the Russell, you have ETFs that you can do this on, or you can go on into the futures options market and do it for 3 times less money, maybe even 5 times less money. So if I was to sell this a short call here, I would sell it 44 days out, which is my number here, right? You can see it. I would go out to 17 to 18 delta, which is not available, so I'm going to stick to 16, which is fine too. And I'm going to sell a single. This is a single option that you're selling. Now, my platform is set up to always come up with 10 contracts, but you should not do that. I should not do that either. I don't do that. It's just the way it's set up. I do need to change that. Anyway, once you're here, you need to go back into your break evens and then move your dates around. So always match this date on top with the date on your break-even cursor here. Your Greeks are still not right here because look, these Greeks are based on the strike price of 261. 261, yes, but it's not based on the current price. You want to check the Greeks at your current price. So you go minus 10 plus 10 again, and this is the current price, the middle line here, the 237 level. These are your actual Greeks. You are short 13 delta because you picked up 16. Your very small gamma position, positive theta. I like that. Vega is low. Would I do this trade in Apple right now? Not really, because it hasn't gone as far up for me as other underlying markets have. I'm a contrarian trader, so I would sell calls when the markets go up. That's why you get the juicier premiums. Market goes up, you sell calls. That's why you get juicier premiums, right? Here, the market stays sideways. It has gone up, but it has also come down. I would sell calls when the market is trading at, when Apple's probably trading at 260 at all-time highs, right? That's what I would do. But anyway, if you do have a position and you are short call, this is how you would adjust and make and risk manage your trade. Let's say you are short call, market goes up. Now, either you hold the stock or you don't. If you hold the stock, it's the best thing because your stock position is going up. You are losing a little bit on your short call, which is fine. But net, you should be positive because of your stock position. If you are just naked call here, no stock underlying position, then this is what I would do. I would go out and convert this into a spread. How do you do that? You just go out and buy the next available strike. Let's say the market has gone up here and then this short call is now trading at 30 delta, not 16. You sold it at 16, but it's trading at 30. Now, if it's trading at 30, I will go out and buy a 20 delta long call, which is one strike out. Depending on your risk appetite, I would make it a $10 wide trade. So if I'm selling at 260, I would buy the 270. You should also always look at the whole numbers here because of the open interest. Now, Apple has a lot of open interest, meaning it's a very liquid stock and a lot of people trade it. There are no problems here trading the 275s or the other strikes or the $5 increments. But depending on your risk appetite, if you can afford a $10 wide strike trade, I would rather do that. So what would I do here? I would go out and buy this 270 strike. So I sold it at 260. Actually, I want to show you some break evens, the actual numbers on the short call first. So here's what the trade looks like. Really good trade. I like this. If I was holding some stock, the reason I like this is because I'm getting 83% of probability of profit, meaning 83% chance that I will make money on this trade. And only a 16% chance that I will lose money, depending on how I manage the whole situation. My max profit, if I hover over this line, is $161 because that's what I'm collecting. My break even has gone down from my strike, so gone up. So 260 plus 161 is what my break even is now. You also should see what your max loss or your margin should be. So go to confirm and send and then see how much money you're putting down. You're putting down $2,600 to make 160. Now that's totally fine. Risk reward is what you give up for the higher probability of making money in these kind of trades. Because you're short call, you are very likely to keep the premium or at least most of it and make money in this trade. But what do you give up on that? So what you give up the capital efficiency of it, meaning the risk reward, meaning you're putting down $2,600 to make 160. Now, if you want to calculate the risk reward on that, open a calculator, which I don't have open here. It'll be a little slow on my computer. Let's see. Now, basically, just divide those two numbers and you know your risk reward. That's how it normally works. So 2,600 divided by 160 is your risk versus reward. So that's almost 10 times, right? So you got 2,600 divided by 160, 16 times. So this is your 16 to 1 is your risk reward. Totally fine with me. I would not worry about that because I'm trying to collect small amounts of dollars more often than losing big, making big one time and then losing nine out of the other 10 times. So this is what my preferred option is. You can go and research the whole thing and see what what suits you. But this is what my preferred methodology and style is, meaning I short options. I've been doing it profitably, consistently for a while. So I know how to manage this trade. Once you know how to manage the risk in this trade, you will never go back to buying options. Trust me. Spend some time learning how to manage this. Putting the position on is totally, anyone can do it with eyes closed. Even a 3-year-old can do it. But it's about how you manage this trade, how you massage it, how you move it on, how you roll it. You should know all your numbers here and there, how much commissions you're paying and everything. So that's the main thing. Anyway, if I was to defend this, if I'm still holding it and I'm closer to 15 to 20 days of expiration, I would think about rolling it into the next cycle. That's one way of doing it. And the way you do that is you would right click here and then I think you go create an opposite order or actually you can buy it back. You can do a close of this trade and then sell it again in the next expiration cycle. So you would buy it back because it's not a trade yet, it's not showing the rolling side of it. So you can put this trade, let's put this trade in. It's my paper trading account, so I don't mind this. So confirm and send, let's put this in. It should fill right away. These are like not real fills, so that's why you see it's filled right away. In the real world, will also fill, but it may not fill right away. It may not fill at that level that you want. So just be mindful of that. So here are my filled orders. Here's the position. I want to see filled orders. Here's the position. So Apple position here. Again, so now this thing is 8 days out. My columns are messed up a little bit. I need to bring in delta and theta. Those are the two main ones. And theta. Double click, it will come up. And IV as well. I usually do that. I mean, that's my real trading account. I have the whole thing set up there. But here, it's a little bit because I don't come here too often, only to make videos. Anyway, if this was a real trade, now you would right click this and create rolling order. So you are selling in April. Look, this is you're buying back the April call option, meaning you see the plus sign here. You're buying back the April. Look at the date because you just sold the April at 260, right? So you are buying back the April and you are selling the same thing in May. This automatic roll will always take you into the next expiration cycle, the available one. Now let's go and check that cycle. 16th of May 25. If you go back to this chain, 16th of May 25 is a monthly cycle. I like that, not a weekly. Weekly cycles are marked in yellow. They expire every week, so we don't want that. I don't trade into weeklies. The open interest and volume is not there. So it will take you into the 16th of May cycle. That's fine. Don't worry about the 73 day number, because when you're adjusting this trade 20 days out or 25 days out or 30 days out from now, this number will come down to 45 days anyway. So that's totally fine. More weekly cycles will open up here. You will see that because weeklies then come up nearer to expiration. Next thing, what else want to show you? So the short call is on, but the way you will roll it, the first thing is to roll this option. So you will right click. I think I already have that order. Why am I doing it again? Oh, actually I don't. I cancel it. So right click and roll it. Create rolling order, right? So now into your 16th of May cycle. Same contract size, +1 here, -1 here, meaning +1 you're buying back this month, and then you're selling into the next month. You can change the strike if you want. The market has gone up, let's say, from 237 to gone up to like 250, whatever. Now you want to sell it at 270 in May. Your net credit is still 28 cents, so you're still collecting net credit. Now here's the important thing. 9 out of 10 times I will roll for a credit, not a debit. When you roll for a credit, you expand your break evens. You are in the trade longer to survive, to defend. You can make all the money back plus the net credit that you are receiving here. That's the main point. If you roll for a debit, meaning you are out of pocket again, you will shrink your break even points, meaning the stock now has less room to move for you to make money. If you expand your break evens, the stock has more room to move, and you will still make money. It would be within your range. But if you shrink your break-even points, then it has less room to move for you to make money. Anyway, more on that later, but this is how you roll. Next thing that you can do is convert this into a spread in the same cycle or in the next one, depending on where you are. If I have 30 more days left in the cycle, I will stay in the, if I have 30 more days to expiration, I will stay in this cycle. If I have less than 20 or I have less than 15, then I will move the short call into the next cycle, and then possibly if you wanted, you can convert it into a spread there as well, but that's on you. If I was to convert this into a spread here, this is how I would do it. So I'm short 16. I will buy the next available strike, which is 265. Again, this is a $5 white strike, so it's up to you. If you want to do a $10 white strike, you just go here, 1 for 1. So don't do the sell one and then buy two or something. So don't do that. So this is how your spread will look like. Now again, these are current prices. The spread will look slightly different because your short option will be slightly closer to the money because the market would have gone up on you, and that's the only reason why you are adjusting the trade and converting it into a spread. Otherwise, why would you do it? So your stock price would be somewhere here. You see my you see the thing here? That's where it is. So yes, I will add. So yes, I will add this long call option on top of the trade, on top of the short call, to convert this into a risk managed position. Meaning, now if you look at that risk side of things, we are only $900, max risk here. And then because now we are paying a debit of 58 cents, this will be deducted from the net credit that we collected. So, and therefore we are left with 101, because 159 minus 58 cents gives you $101. So now your risk reward is slightly better. So you are collecting $101, and your max risk is $900. So it's 9 times versus 16 times, or almost double it was last time. Okay, so we have talked about moving the short call position out. We've talked about adding a long leg to your short position. That's two ways of doing it. The third way is, once you have the spread here, you can also move the whole spread out to the next cycle. Like when I trade the short side of the market, I go in with like spreads. My main bread and butter is going either short put spread or short call spread. So I'm always, I'm taking that long leg with me because it's risk control. I like the risk reward and everything. So then I try to move the whole spread out to the next expiration cycle. So again, if you're just naked short call, and if you're closer to expiration, last 15-20 days left, I would move the short call out to the next cycle, select the new strikes, start again. If you're still in the same cycle and you think that the stock has gone up too much, I will convert this into a spread and stay here for it to come back to you one more time. If it doesn't, then again, move the spread out. Now you're sitting with a whole spread, so you can just take the whole spread out, which is fine. It defines your risk. Yes, it gives you a little bit less credit, a little bit less money to make than your initial credit, but then you also have a lot more buying power that comes back to you, right? Before you were down $2,600 to trade this, and when the stock moves closer to your strike price, you get more and more margin calls, meaning your account, the margin balance that you have to put down increases. So when you convert this into a spread, that thing just goes away, and then you know exactly how much your margin is, which is the max loss on the trade. And why is it $900? It's because it depends on the width of the strike. So your short, the width of the strikes are 270 minus 260, that's $10 minus the credit that you collect. So you've collected net $101, meaning 101. So 10 minus 101 is 899, and that's what your max loss is. If you hover over this line here, that's what your max loss is. Your max gain or your max profit, if you hover over this line, is around $101. Now, I think the best thing would be for me to do this, just do a whole trade cycle, like a 44-day cycle, like how the trade goes. When the trade goes bad. When it goes good, it's fine. You don't need to do anything. You just put it on, collect money, and then close it out. But when it goes bad, when the markets move up, these are the steps that I take. These are the things that have worked for me, and this is exactly what I teach and I tell people. So if you have any questions, just put in the comments. If you like my videos, hit subscribe. I have a long list of videos to make, and maybe at least, I don't know, maybe 50 to 60 videos already, the titles that I've decided that I need to make videos on. So hit subscribe so that you know exactly when the videos are coming up, and then you get the notifications and everything. And I have nothing to sell right now. Everything is free. Just trying to share the knowledge that I have and see if I can get some people along the board, along with me to do these kind of trades. Thank you for watching. Bye-bye.